This is Nightly Business Report with Bill Griffith and Sue Herrera.
Trade tensions. The Trump administration imposes steel and aluminum tariffs on imports from some of our biggest trading partners and our closest allies, and they are hitting back hard.
Stocks tumble. Trade retaliation does send chills through the market, and investors look for answers as uncertainty grows.
On the waterfront, how increasingly severe weather is creating a new risk to real estate. The launch of our series takes us to Boston. Those stories and more tonight on Nightly Business Report for Thursday, May 31st.
And we do bid you good evening, everybody. Investors did not exactly like what they heard when the White House said today that it is making good on its threat to impose tariffs on some of our largest trading partners and closest allies. Starting at midnight tonight, Canada, Mexico, and the European Union will no longer be exempt from levies on steel and aluminum. The tariff on steel will be 25% and 10% on aluminum. And the specter of a trade war made Wall Street very nervous today. Stocks fell to close out the month of May. The Dow fell by 251 points to 24,415. The Nasdaq was down 20, and the S&P 500 lost 18. And the response from the countries affected was quick and it was stern. Eamon Javers is covering this story for us tonight from Washington.
These tariffs are totally unacceptable.
The response from allies was swift. Canadian Prime Minister Justin Trudeau condemned the move.
These tariffs will harm industry and workers on both sides of the Canada-U.S. border, disrupting linked supply chains that have made North American steel and aluminum more competitive all around the world.
Canada will retaliate with tariffs on up to more than $16 billion in imports of steel, aluminum, and more. The European Commission says it's ready with tariffs on $7.5 billion in imports on products from makeup to motorcycles and motorboats. Mexico will also retaliate with $4 billion in tariffs on steel pipe, cheese, and pork. The Trump administration says the president has the flexibility to change or remove the tariffs on steel and aluminum imports at any time. And Commerce Secretary Ross dismissed concerns about damage to the relationship with allies.
These are blips in the radar screen. I don't think they change the fundamentals of relationship. Everybody has spats every now and again.
Trudeau made clear that to him, these are real issues, not blips.
This is perhaps more significant than the administration realizes.
Ross also dismissed the cost of tariffs on the massive U.S. economy.
That's a tiny, tiny fraction of 1%.
Former Treasury Secretary Larry Summers says that's a miscalculation.
His calculation takes no account of the uncertainty that will deter investment for anyone who's using inputs.
It's not just global allies who are critical of the move. Some of the president's political allies are critical as well. Some business leaders are calling the tariffs a costly mistake. And Kevin Brady, the chairman of the House Ways and Means Committee, says the tariffs are hitting the wrong target. He called on the administration to continue to exempt our national security partners. For Nightly Business Report, I'm Eamon Javers in Washington.
And Moody's says those tariffs will likely hurt the U.S. economy by causing input costs to rise for manufacturers. And it added that certain U.S. exporters could be hurt by the retaliatory measures, though the tariffs may help some domestic metal companies.
All right, let's talk more about this brewing trade war and what it could mean for investors. Joining us tonight, Jeff Bush, who's a partner at the Washington Update. Good to see you again, Jeff. Welcome back.
Thank you, Bill.
You're not exactly enamored of this strategy, are you?
Well, I think it's an interesting strategy. It's certainly a heavy-handed strategy. I think the president is showing a firm hand to our allies as a way of showing his focus on the international issues with Iran, Iraq, and so forth. I think this is a much broader issue than simply a trade scenario.
In what way?
Well, I think both trade and foreign relations are actively being negotiated right now. I think the president sees them really two feathers of the same bird, and his negotiating style is to, again, show our allies a firm hand to show our resolve to our enemies. And all of this, both of these issues, foreign relations and trade, are standing on the same balancing point. And that is, where is the faith in our negotiating partners that the President Trump will deal with them consistently and fairly? And I think that's what we need to see from the Trump administration heading into all of these negotiations, is do we see a consistent, fair approach? And how is that received by those people on the other side of that table?
For investors, at a minimum, Jeff, this could be inflationary as it raises prices on these things that are being imported or exported. But at the worst, it could mean a loss of jobs for those companies that are being squeezed out, can't afford the tariffs, and they lay people off. What are investors to make of this, do you think?
Well, I think from an investor perspective, there's really two things to focus on. Yes, inflation is certainly an aspect of that, but also volatility. And from an investor perspective, volatility is not necessarily bad, but it does change your approach to your investing profile. Generally speaking, in a more volatile environment, an active strategy is going to do better than a passive strategy, but the risk of gain is significantly higher, but harder to find. And the risk of a downside loss is generally a little bit larger. On the inflationary side, yes, prices are going up, would go up in a trade war scenario, but as long as corporations can pass that along to consumers, then we won't really see any impact to the corporate earnings scenario. What my concern is, you can only pass those costs on if there's wage growth. And we haven't seen a lot of wage growth in this recovery period.
Jeff, you know, there were a lot of people who were talking about what the long-term ramifications are from the move from the administration today. Yes, it may be a negotiating tactic. Yes, it may get walked back or changed, but it's the uncertainty of that. And they worry that with key trading partners like Canada and Mexico, that there are long-term ramifications in terms of lack of trust. Do you agree with that or not?
I absolutely agree with that, Sue. I think this is a very high-risk, high-gain type of negotiating strategy. But in fairness, a low-risk, low-gain strategy over the past several administrations hasn't really moved the needle either. So I think it is a different approach, and I do believe in the long term we'll move back towards a free trade environment with our closest allies. But your point is exactly correct. What damage has been done in that interim process?
Jeff Bush with the Washington Update once again. Thanks for joining us, Jeff.
Thank you very much.
And with geopolitics in focus, investors paid attention to the meeting between Secretary of State Pompeo and a North Korean official. The secretary said there's still a lot of work to do before a summit between the two countries can take place, but he is optimistic.
We've made real progress in the last 72 hours towards setting the conditions. The conditions are putting President Trump and Chairman Kim Jong-un in a place where we think there can be real progress made by the two of them meeting. It does no good if we're in a place where we don't think there's real opportunity to place them together. We've made real progress towards that in the last 72 hours.
North Korean officials will deliver a letter from their leader, Kim Jong-un, to President Trump tomorrow. He will be in Washington.
More positive reports on the economy today. Spending strengthened further in April as incomes rose. Personal consumption expenditures, that's a measure of just about everything that households spend their money on, that rose 0.6% last month. That was the biggest increase in 5 months. Economists say the report is a sign that consumers could drive even stronger economic growth in the current quarter.
And citing the economy's strength, a Federal Reserve official says a gradual interest rate increase remains appropriate. Governor Lael Brainerd said that the recent tax cuts and higher federal spending will reinforce above-trend economic growth.
Time to take a look at some of today's upgrades and downgrades. We begin with Micron Technology. Their rating was lowered to equal weight from overweight at Morgan Stanley. The analyst cites storm clouds on the horizon and says that he's concerned about the strength of the memory chip market overall. Price target now is $65. That stock has been the best performing chip name in the S&P 500 this year, but today it fell nearly 8% to 57.59. Meanwhile, UBS is reaffirming its sell rating on Tesla. The analyst is predicting that the company is going to need to raise capital by the end of the year. Price target now $195, and that stock fell more than 2% to $284.73.
Still ahead, the milk market runs dry for some American dairy farmers.
I'm Contessa Brewer in Smithfield, Kentucky, at one of more than 100 dairy farms facing a looming deadline today, the end of their contract to sell milk. Are there any new buyers for these American dairy farms? Coming up on Nightly Business Report.
The Federal Reserve has reportedly labeled Deutsche Bank's U.S. operations as troubled. In fact, according to the Wall Street Journal, this rare designation by the Fed actually took place about a year ago. That means that Germany's biggest bank has been subject to operational constraints, like having to seek approval before hiring and firing senior managers. The central bank has also influenced moves by Deutsche Bank to reduce risk. Stock hit an all-time low today. It fell 4%.
Uber's CEO says his ride-sharing company is on track to start trading its shares next year. Speaking at the Recode conference, the head of the company said the company is in a good position, but a couple of things need to happen before it can go public.
The management team has to be filled out. I am looking for a CFO, and that's a pretty important person as part of an IPO. We are very much now rebuilding the brand and what Uber represents, and I think we're making terrific progress.
Separately, the company's CEO confirmed that he had been in talks with Berkshire Hathaway's Warren Buffett, and he said those talks perhaps will resume one day.
General Motors' driverless car unit is getting a $2 billion investment from SoftBank. And once that deal closes, the automaker itself will also make a $1 billion investment in the unit.
I think it's a big recognition and validation of the progress we've made over the last couple of years to get to this point. But I think it also is a big recognition of the opportunity that lays ahead as we look to commercialize this technology in really big scale. It's going to require capital to do that. This obviously is a new source of capital for us as we look to grow this business and realize what we think is a very, very large opportunity around autonomous technology.
And in fact, that investment sent shares up nearly 13%, its biggest one-day gain since the company relisted back in 2010 after its bankruptcy in 2009.
Fiat Chrysler is also pushing further into the self-driving car business. That automaker is expanding its partnership with Alphabet's autonomous driving unit, Waymo. Fiat Chrysler is adding tens of thousands of minivans to Waymo's fleet of self-driving vehicles, and that sent its shares up more than 4% in trading today.
And from cars to planes, there's a big and expensive battle brewing at Los Angeles International Airport. Airlines there are pouring billions into that airport in a costly but critical fight to win over those traveling through the country's second biggest airport. Phil LeBeau is at LAX for us tonight.
This is ground zero in the airline war to win over customers. LAX, considered a hub by three major airlines, is being remade by those carriers. The latest investment? $1.9 billion by Delta to renovate two terminals.
We're the fastest growing airline here in LA. Over the last 10 years, over the last 5 years, we've grown 60%. We're out of capacity. We can't bring any more customers through until we redevelop the terminals and the experience for the local Angelinos.
When it comes to winning at LAX, Delta is in a dogfight with American, United, and Southwest, all using the airport to grow their bottom lines. LAX is lucrative for airlines for a couple of reasons. First, it has a huge number of international flights. And second, it's a hub for high-end travelers coming to or from Southern California.
They're fighting it out for the long-haul customer and the people who pay the big bucks to sit at the pointy end. That's where the profits are made.
American has invested more than $1 billion upgrading its operations in LA, including a redesigned Admirals Club. And United is now offering high-end travelers at LAX a personal suite when they check in and rides to their planes in a BMW. So Delta is focusing on giving its LAX customers a better experience.
We need to make certain that our airports, whether it be security, whether it be check-in, whether it be the boarding process, is the same hassle-free experience as what we're trying to create in the air.
A battle on the tarmac and at the gates of America's second busiest airport. Phil LeBeau, Nightly Business Report, Los Angeles.
Sears is closing more stores. That's where we begin tonight's market focus. After reporting a wider than expected loss and a decline in same-store sales, the struggling retailer said it was planning to shut down 72 unprofitable locations, and it added that it is still open to considering third-party partnerships with its brands in a move to drive profits. Shares fell more than 12%. They finished the day at $2.81. Dollar General blamed its disappointing quarterly sales on an unseasonably cold spring. The discount retailer said fewer customers shopped at its stores and added that higher costs in that period pressured margins and overall earnings. Shares finished down 9% to $87.48. And its rival, Dollar Tree, also said the weather had a negative impact on results. The retailer's same-store sales came in below expectations, and it's lowered its annual profit forecast. The company also took a hit from higher freight costs. Shares were off 14% to $82.59.
And investors had their first chance today to react to Guess's disappointing outlook. Last night, the company reported a quarterly loss that was pretty much in line with expectations, but the focus was on its forecast, and investors punished the stock today, sending it down 19% to $19.60. Then after the bell tonight, GameStop reported earnings that topped expectations. Even as the company suffered declines in its core business, revenue came in a little light at the video game retailer, and shares of GameStop were initially under pressure in the extended session. They finished the regular day down more than 1.5% at $13.20. Also out after the bell tonight, Lululemon delivered a solid quarter, reporting same-store sales that blew past estimates and a higher than expected rise in profitability. The athletic apparel company also gave upbeat earnings and revenue guidance for the current quarter. Shares were initially higher after hours, but finished the regular session down 0.5% at $105.05.
And the big retailers like Walmart and Kroger are getting into the milk business, and that is spelling trouble for dairy farmers across the country. Their business is becoming increasingly squeezed by the changing dairy landscape. Contessa Brewer reports tonight from a family-run dairy farm in Smithfield, Kentucky.
When dawn breaks in the countryside outside Louisville, Kentucky, the work starts. 3 generations have milked cows at Jericho Acres Dairy, and a 4th generation is getting an early introduction. It's a small farm, but the foundation for some big dreams.
It was all about continuing the family business, doing continuous improvements to our facilities, growing our herd to include better genetics and better cows.
Those dreams were unexpectedly disrupted by a letter from Dean Foods, which buys all their milk.
I regret to notify you, we must cease purchasing milk from your dairy farm.
More than 100 farmers in 8 states got the same letter, canceling their milk supply contracts in 90 days. Dean Foods blames, in part, competition, a new milk processing plant opening in the region. Walmart is entering the processing business with a new plant in Fort Wayne, Indiana. It will bottle milk for its own Great Value store brand, sourcing milk mainly from 3 nearby co-ops and a handful of independent farmers. Dean Foods, facing falling sales and profits, says it is right-sizing its network to better match volume. It will continue to process milk for Walmart in other regions, but is likely to face increasing competition as other big grocers like Kroger's are already in the processing game. Walmart tells us in a statement, while many of the farms that received letters from Dean Foods were far outside of the service area of our plant, a number of them closer to Fort Wayne have signed contracts with the cooperatives to work with Walmart. At a national average of $3.23 a gallon, milk prices are lower now than 10 years ago. Plus, Americans are moving on from milk. Consumption's taking a steady dive, with overall sales dropping almost 15% since 2012.
We knew that we would have to do something a little bit different, whether that be value added or agritourism, bottling our own product.
But those plans all included building their herd significantly. Instead, with no new buyer on the horizon, the Combs are culling their cows. Since the arrival of the Dean Foods letter in March, they've sold more than half the herd to other dairies or to meat processors.
My son told me the other day after the cows left, he said, all the cows gone? I said, yeah. He said, I'll go find them for you.
Of the 20 Kentucky farms that had their contracts canceled by Dean Foods, 14 still have found no new buyer for their milk. The other 6 have already sold out.
We didn't do anything wrong. Like, it wasn't bad management. It wasn't not managing our finances correctly or our cattle correctly. We produce good quality milk here.
For now, Jericho Acres Dairy has been given a reprieve, a contract extension of 30 days to try and find a home for their milk. In Smithfield, Kentucky, Contessa Brewer, Nightly Business Report.
Still ahead, the Water's Edge. This is a new series that takes us to Boston tonight, where that city's real estate is at risk from severe weather.
Mortgage rates have pulled back from their 7-year peak. According to the latest report from Freddie Mac, the average 30-year fixed rate declined to 4.56%. As you know, mortgage rates tend to move along with the benchmark 10-year Treasury, and that has rallied on global concerns.
Well, don't look now, but hurricane season starts tomorrow. And if last year is any guide, storms in general are getting more dangerous and destructive. And today, we start a new series looking at the rising risk to real estate, especially development that could sit directly in harm's way. Diana Olick reports tonight from Boston with a look at what's being done there to safeguard buildings and billions of investment dollars.
Winter slammed hard into Boston this year. Back-to-back nor'easters sent water flooding into its historic streets and seaport. It was what city planners predicted, just not yet.
In Boston, we've spent a lot of time thinking that these impacts are 20, 30 years down the road. These storms are here now. They're happening more frequently. They're more severe.
Deanna Moran studies the impact of climate change on Boston real estate, especially its new development.
And the planning has been great, but we just aren't there yet.
The planning started at the top in the mayor's office and its Climate Ready Boston initiative, headed by Austin Blackman.
If you want to build a large building in the city of Boston, not only do you have to take into account what the climate projections are and the floodplains are right now, but you have to look at what those projections are in the future.
But so far, it's just conversations and recommendations, not rules and regulations. And data show the water is rising and the storms are intensifying, just as development is booming in the city's most vulnerable district, according to experts, the Seaport.
When we picture rising tides and stronger storms, we tend to think of places like Miami and the Gulf Coast. But with the exception of Alaska, New England is expected to see greater warming than any other place in the U.S. because of its higher latitude.
And its proximity to the Gulf of Maine, the fastest warming body of water on Earth, according to the National Oceanic and Atmospheric Administration. In the past decade, nearly $8 billion worth of residential and commercial real estate has been built or approved for construction in the Seaport, its inventory of properties doubling, according to CBRE. In fact, just the Seaport has seen 3 times the amount of new buildings going up than in all the rest of Boston's much larger downtown and financial district. And the Seaport is ground zero for water. This is what the city predicts will happen in 10 years, 20 years, 30 years, the booming district underwater.
I think what scares me the most is the disconnect. We're relying on the historical past when we build buildings for the future.
Why are we not changing the code?
The process for changing the code is long and tedious.
And changing the code could drive away the precious influx of big business to Boston. Names like Amazon and GE investing millions in Boston real estate development and attracting thousands of new workers, especially to the Seaport.
So this is 121 Seaport, a building that, on behalf of Skanska, I'm incredibly proud of.
Skanska is one of the largest Seaport developers, recently selling 2 of its new buildings for record prices. Its latest is the centerpiece of Seaport Square.
It's shaped like an ellipse, and that shape alone is very sustainable in that the wind on this building is far less than it would have been had it been a square or rectangle.
So I'm looking out over water, 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 water everywhere. No concerns.
No concerns at all. This building is very well prepared to withstand any major storm event.
The building's electrical infrastructure is 40 feet above the 100-year floodplain. The ground floor is elevated. All of this at increased cost. While some developers are proactive, others are less so because they know the end game is to sell the building.
What we are starting to see is that developers will not necessarily qualify for financing because the insurance companies are saying, hey, we're not going to insure this unless you take into account some of those climate challenges.
Why build? Why develop the seaport?
Right now, we've already got significant number of buildings and assets that are already in harm's way. As we look at continuing to develop it, there's actually an opportunity for those developments to be part of those protection processes.
Like GE, building its proposed $200 million headquarters in the Seaport District and elevating the ground underneath to protect against rising tides. But the planning has to go beyond individual buildings or so-called islands of resilience.
What are the barriers that frustrate you most?
Not having control over the building code as a city.
There are guidelines, but everything is ultimately voluntary.
This is value right here, what you're looking at, the old in with the new.
Absolutely. I think one thing is tried and true. They want to be by the water, but they want to be in a building that is very well prepared to withstand storm events in the future.
For Nightly Business Report, I'm Diana Olick in Boston.
And to read more about the storm risk to real estate, you can head to our website at nbr.com.
And before we go, here's another look at the day on Wall Street. The Dow fell 251 points, the Nasdaq was down 20, and the S&P 500 lost 18. On to June.
Tomorrow's the day.
Tomorrow is the day, and we'll be there for that. That's it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.